Hello again, it's John Glougie, one of the portfolio managers at Luft Financial, IA Private Wealth. Today we're here to talk about the emotions of investing. We all know investing is very much about the numbers, but we often forget about the emotional side. And so today we want to tap into that and see what sort of impact emotions can have on your investment portfolio. So anybody can tell you how easy investing is. You buy low, you sell high. Easy, right? Well, what happens in reality? Let's let this graph help show us the way. What you generally find is that as markets rise, people start getting a little more optimistic about the markets, start feeling that temptation to put money into the markets. The further the market goes up, the more confident we are in this decision. Until we get to that euphoric state, markets are at their all-time highs, we're feeling great about it, we want to throw more money into the market because look how well it's performed. As soon as that market pulls back, though, that's when denial sets in. Well, maybe it's just a temporary sort of blip. I'm going to stay the course, fine. Once it falls a little bit further, that's when we really start panicking, and panicking at the wrong time. If we start letting our emotions get the best of us at this point in time, we can do some devastation to our portfolio. So not only does bailing out of our investments have a devastating impact on our portfolio, what it also does is it leaves us feeling a little depressed at how bad markets were. We had to take some lumps in the portfolio. When the market starts coming back, we're probably a little bit more timid getting back into the market. We need to sit back and wait to see if this is going to be a simple week-long phenomenon or a general trend. Once the market has been rising for a little while, and we start getting that optimism again. Maybe it's a good time to get back in. Once the market's recovered almost fully, we're confident we can put money back in. Let's buy when it's high again. The problem with the investment universe right now is it's often being driven by market headlines or just news headlines. As you can see from this example, if we wake up one morning, pull out the newspaper, and we're told the sky is falling, it becomes a self-fulfilling prophecy. That's the way we think, that's what we start to believe, and that's what's going to be driving our emotions. This is the biggest problem with bailing on your investments at the wrong time, panicking at the wrong time. Generally, after a few bad days or one really bad day in the market, it's not uncommon to see a really good day in the market. We saw that only a few weeks ago here in North American stock markets or around the world. Those bouncy days are very, very important to your portfolio. So this is a slide that will help us show, this is from Bloomberg, what happened in the Canadian stock market between the 2008 crash and 2020. And what it shows us is if you were to take the best 10, 20, or 30 days returns out of your portfolio over that 12-year period, these are the sort of impacts they have in your portfolio. So as you can see, if you missed the 30 best days, wherever they may be, the 30 best days on the market, your $10,000 investment into the TSX would be worth $4,800 later, 12 years later. If you missed the 20 best days, your portfolio's still down to $6,500. If you only missed the best 10 days, you're still not back to par. Your $10,000 investment is only worth $9,600. But if you did not panic and you kept your money invested for the long term to run through the cycles, in this same example, your $10,000 TSX investment would be worth $17,640. So as we go through these periods of extreme market volatility, don't lose sight of those best 10, 20, 30 days on the market. They will show up out of nowhere and for no good reason. It's times like this that we really need you to remember your investment time horizon. Why did we put the money away and what was it intended for? At this point, we probably sound like a broken record, but if you need money within the next year or two, you should not have that money invested at the best of times anyways. You should keep that money in savings, in cash or a cash equivalent or something close to cash. Keep it away from market volatility because you know you're going to need it in the near term. If it's longer term in nature, you have money set aside for retirement in the long run, or maybe to buy a house in 5 or 10 years, you can leave that money invested so that you don't miss those big bouncy days. So just remember, when markets get tumultuous, when they get volatile, we've been through this before. We've seen this before. It's never different The headlines may change, but the market's reaction to them generally don't. So if you are losing sleep over any of this volatility, if you feel you need a hug, that's why we have advisors. That's why we're here. Please lean on us as we will on you if we feel the same need for that hug.